Smart Money Concepts course. In this section, we'll explore the essential terminology that forms the foundation of SMC trading. Understanding these terms is crucial because they replace traditional technical analysis concepts with a more institutional perspective. We will define and identify order blocks on price charts, understand breaker blocks and their significance, recognize fair value gaps and explain their importance, and identify breaks of structure and changes of character. By mastering this terminology, you'll develop a new language for reading price charts that aligns with institutional thinking rather than retail perspectives. Smart Money Concepts introduces several terms that replace traditional technical analysis concepts. Understanding this terminology is essential for mastering the SMC approach. In traditional technical analysis, we often focus on concepts like support and resistance, trend lines, and various patterns. SMC doesn't discard these concepts entirely, but reframes them through an institutional lens. This shift in terminology is important because it changes how we perceive market movements. Instead of seeing abstract patterns, we begin to recognize the footprints of institutional activity. This allows us to align our trading with the smart money rather than unknowingly providing liquidity for their operations. Let's start with one of the most fundamental SMC concepts: order blocks. In traditional technical analysis, we identify support and resistance as horizontal price levels where the market has previously reversed. In SMC, we replace this with the concept of order blocks. Order blocks are areas where significant institutional orders have been placed, often visible as the last price action before a strong move in the opposite direction. Let's look at a clear example in the gold market. Notice how price made a strong move down after this highlighted candle. This candle represents a bearish order block, the last area where institutions placed significant sell orders before the downward move. When price later returned to this area, it served as resistance, leading to another drop. The same concept applies in stock markets. Here's Tesla showing a bullish order block, the last down candle before a strong upward move. When price later returned to this area, it found support and continued higher. Order blocks are powerful because they represent areas of unfilled institutional orders. When price returns to these areas, those orders are likely to be activated again, causing price to react similarly to the previous occasion. Now let's discuss breaker blocks. Breaker blocks are failed order blocks. When an order block fails to hold the price, it breaks through, potentially indicating that the smart money direction has changed. Here's an example from Bitcoin. This area initially acted as a bullish order block, providing support when price returned to it. However, when price eventually broke through this level, it became a breaker block. Notice how it then acted as resistance on subsequent retests. The same principle applies in Forex markets. In this USD Canadian dollar example, a bearish order block that previously acted as resistance was broken to the upside, becoming a breaker block that then acted as support on retests. Breaker blocks are significant because they signal a potential change in institutional positioning. What was once an area of buying may become an area of selling, or vice versa. Next, let's explore fair value gaps. In traditional technical analysis, we often look for price gaps, especially in markets that close, like stocks. But in 24-hour markets like Forex, these gaps are less common. Here's a traditional price gap in the S&P 500, where no trading occurred between the close of one session and the open of the next. SMC introduces the concept of fair value gaps, which represent imbalances between supply and demand. These are visible as a significant space between the bodies of candles, indicating a rapid price movement that left an unfilled area. On a bullish move, a fair value gap would be identified as the space between the high of one candle and the low of the next candle when there's no overlap. These areas often get filled later as price returns to balance. In this Ethereum chart, we can see several fair value gaps created during strong moves. Notice how price eventually returned to fill these gaps in subsequent price action. This tendency makes FVGs valuable for identifying potential price targets. Another SMC key term is break of structure. A break of structure occurs when price surpasses a significant high or low, indicating a potential change in market trend. In this pound-yen example, we can see an uptrend with higher highs and higher lows. The bearish break of structure occurs when price creates a lower low, breaking the previous market structure. This signals a potential trend reversal. Conversely, in this Apple chart, we see a downtrend with lower highs and lower lows. The bullish break of structure occurs when price creates a higher high, breaking the previous bearish structure. Breaks of structure are crucial for identifying potential trend changes early. They often precede larger moves and can provide excellent entry opportunities when combined with other SMC concepts. A common SMC terminology is change of character. Change of character refers to a notable alteration in market behavior, often seen through an abrupt increase in volatility or a shift in price direction. In this silver chart, notice how price had been moving in small-bodied candles with limited volatility. The change of character occurs with the sudden appearance of large-bodied candles and increased volatility, signaling a shift in market behavior. Changes of character often coincide with increases in volume, as seen in this Netflix chart. The sudden surge in both price movement and volume indicates a significant shift in market participation, likely due to institutional activity. Identifying changes of character early can alert you to potential trading opportunities as new trends develop. Let's analyze this complete example from the AUD-USD market, incorporating multiple SMC concepts we've discussed. On the daily time frame, we can identify the market structure as bearish, with a series of lower highs and lower lows. Zooming into the 4-hour time frame, we can identify this area as a bearish order block, the last price action before a strong move down. We can also see a fair value gap created during this strong downward move. When price later returned to the bearish order block, it provided a selling opportunity. Our entry would be near the bottom of the order block. We'd place our stop loss above the order block to protect against the possibility that the institutional orders have been exhausted. As we can see, the trade developed as expected, with price respecting the order block and continuing in the direction of the overall trend. Additionally, price eventually filled the fair value gap we identified, providing a logical target for partial profit taking. To summarize what we've learned, order blocks represent areas where significant institutional orders have been placed. Breaker blocks are failed order blocks that may now act as the opposite type of support resistance. Fair value gaps represent imbalances that often get filled in later price action. Breaks of structure signal potential trend changes, and changes of character indicate shifts in market behavior. Before moving to the next section, I recommend you practice identifying order blocks on at least 5 different charts. Look for examples of fair value gaps and observe whether they get filled. Identify breaks of structure and note how price behaves afterward. And create a quick reference guide of these SMC terms for your trading journal. In our next section, we'll explore the psychology of smart money, understanding the mindset of institutional traders, and how to overcome the psychological disadvantages faced by retail traders.